Good morning, Tanya Sanwal, Vice President and Product Specialist for Fixed Income Strategy in Pimco. Could you please explain us the income strategy?
Good morning. So at Pimco, we have seen that income has been a key theme for clients, particularly given how low interest rates are across developed markets. We have developed a suite of income-oriented strategies. The key objective here is number one, to pay out a consistent distribution, and secondly, to have long-term capital appreciation across our suite of income-oriented strategies.
What is the outlook for the bond market in an environment with low rates and low yields?
So certainly the environment of very low government bond yields, particularly in developed markets, have been a challenge for investors. The first point I'd like to make is that bonds still do continue to play an important role in the context of an overall portfolio. Why? It's because they provide number one income, but more importantly because they provide good diversification, protection in an environment if risk assets were to sell off. So we do still see value for bonds in the portfolio. Now, secondly, our economic outlook is that we expect economic growth to be stronger in 2015. So we are expecting around 2.5% to 3% type growth in this year. We also think that on average, central banks are going to continue to be accommodative. So you see the European Central Bank, Bank of Japan continue to undertake quantitative easing. At the same time, while the Fed is expected to raise rates, we expect this is going to be slower and a gradual process. So in an environment where economic growth is strong, you also have central banks being quite supportive, risk assets will typically do well. So how are we constructing portfolios today? Firstly, with respect to interest rate sensitivity, interest rate and duration, we are relatively underweight versus our neutral point. So we are de-emphasizing high-quality government bonds in the portfolio. Secondly, what we do like are more credit-oriented assets that have lower sensitivity to interest rate risk. So, for example, we like select emerging market debt, we like securitized credit in the US, we like bank capital in Europe, we also like peripheral debt in European countries such as Italy and Spain. Finally, we also see value in inflation-linked bonds, particularly in the US and in Europe, given the valuation that we are seeing in the markets right now. Finally, with our mixed asset portfolios where we can invest in both equities and bonds, we have a slight overweight to equities versus bonds in our portfolios, which again reflects our risk-on posture.
Among the products in this strategy, which is the ones you particularly want to push this year and why?
So as I mentioned, we have developed a suite of income-oriented portfolios. We have strategies that are fixed income only, such as the GIS income fund. We also have strategies that are targeting equity dividends, and we also have mixed asset strategies, which are a blend of fixed income and equity. I would say the strategy that makes the most sense for investors is one which is suited for their individual objectives of income, volatility, their risk tolerance, and whether they are in an accumulation or a deaccumulation phase. So for clients who are looking primarily for consistent income, capital preservation, and low volatility, something like the GIS income fund, our global income fund, would make the most sense. For strategies, for investors who are willing to take on a little bit more risk, something like the GIS strategic income fund, which is 75% fixed income, 25% equities, would probably be more suitable.
Thank you.